Welcome back to Curious Commerce. Today we will discuss about the limitations of fund flow statement and steps in preparations of fund flow statement. So in our previous session we saw the importance of fund flow statement. But remember one golden rule in commerce. Every financial tool has its limitations. Yes, even the fund flow statement is not perfect. If we follow on it blindly, it may lead to wrong conclusions. Today, we will clearly understand the major limitations of fund flow statement based on the past data. It ignores the detailed cash position and not useful for short-term liquidity. Let's understand each one in very simple way. The first limitation is fund flow statement is based on historical data. What does this mean? It is prepared using previous balance sheet, past financial positions, or past financial records. So it mainly tells us what happened in past, not what will happen in future. Why is this a problem? Because decision often requires future planning, forecasting, and predicting the cash needs. But fund flow statement is backward looking, not forward looking. Fund flow statement is useful for analysis but not sufficient for future forecasting. Second one is ignores detailed cash position. Because in fund flow statements, funds usually mean working capital, not actual cash. A company may show increase in working capital, but cash balance may actually be low. This creates confusions. Fund flow statement does not give detailed cash information. For that, we need cash flow statement. The third limitation is not useful for short-term liquidity. It means the ability of a business to pay salaries, creditors, and immediate expenses on time because it focuses on working capital changes, not immediate cash availability. Fund flow cannot clearly answer these urgent questions of the business. For short term liquidity analysis, cash flow statement is more useful compared with fund flow statement. Fund flow is good for long term financial movement but weak for immediate cash analysis. Let's revise quickly. It is based on the past data. It ignores the detailed cash positions not useful for short term liquidity. So, learners, now you clearly understand the limitation of fund flow statement. Preparation a fund flow statement is actually very simple if you follow the correct steps. Many learners get confused, but today I will give you a three-step formula that makes it easy. The three important steps are schedule for changes in working capital. Second step is fund from operations. Third step is fund flow statement. Let's understand each step quickly. Schedule of changes in working capital. This is the first and foundation step. Here we compare the current asset and current liabilities of two balance sheets. We calculate the working capital using the formula working capital equals current asset minus current liability. Then we find increase in working capital or decrease in working capital. Why this step is important? Because fund flow statement is based on working capital concept. Without this schedule, we cannot proceed correctly. Remember, step 1 tells us whether working capital is increased or decreased. Step 2 is fund from operations. Here we calculate funds generated from normal business operations. We start with net profit. Then we make adjustments. Add back the non-cash expenses. We add the items like the depreciation, amortization, loss on sale of asset, because these reduces profit but do not reduce funds. And deduct the non-operating income. We subtract items like profit on sale of assets and dividend received, because these increase profit but are not from operations. After adjustments, we get funds from operations. This is usually a major source of funds. And third step is fund flow statement. Now the final step. Here we prepare the fund flow statement showing sources of funds and applications of funds. Under the sources of funds, it includes funds from operations, issue of shares, long-term loans, and sale of fixed assets. Under the applications of fund, it may include purchase of fixed assets, repayment of loans, payment of dividend, and increase in working capital. The total of sources must equal total of applications. Let's revise the three-step formula. Step 1 is schedule of changes in working capital. Step 2 is fund from operation. Step 3 is fund flow statement. Follow this order and the problem becomes easy. Working capital is the money required for daily operations. Without working capital, even profitable businesses collapse. A grocery shop earns profit monthly, but if it cannot buy goods daily due to the lack of cash, business stops. Profit is long term success. Working capital is day to day survival. We are using the formula for calculate the working capital is current asset minus current liabilities. The difference between the current asset and current liability we called as in the working capital. Current assets are the items easily converted into cash within 1 year. For example, cash in hand, bank balances, debtors, and inventory. Current liabilities are short term obligations like creditors, bill payables, and short term loans. The end of the session, we know that the limitations related to the fund flow statement. It is based on the past data, ignores detailed cash positions, not useful for short-term liquidity. The main steps we will follow for prepare the fund flow statements. The first one is schedule of changes in working capital. Second one is funds from operations, and third one is fund flow statement. In the next video, we will learn about the working capital cycle and the schedule of changes in working capital. Please like, subscribe, and share. If you need the daily updates follow WhatsApp channel Curious Commerce Financial Management Hub. Thank you all.